Morgan Stanley Wealth Management Chief Investment Officer Lisa Shalett joins us now. Lisa, great to have you back on the show. We have been increasingly getting more of this type of commentary in recent weeks as the data has come in stronger than expected. And then, of course, this morning, that incredibly robust retail sales print as well. I want to get your thoughts about the market rally we've seen so far to start the year and how that jives with what the Fed has been saying and what former Fed officials like Blinder have been saying.
Yeah, look, I think it's very clear that the liquidity in the market, consumer savings, and optimism about the job market continues to support consumption. And, you know, for the Fed, this is really problematic because part of the reason that central banks raise interest rates in a battle with inflation is to cool demand. And that cooling of demand on the consumer side of the economy, on the services side of the economy, is just not coming through yet. And so this is a stock market that, in our humble opinion, you know, began to rally last October in large part on these grand hopes that the Fed was, quote unquote, near done or at the pause and were imminently going to cut in 2023. And I think as every day goes by and we get data that suggests that the first quarter of this year is quite a bit stronger on almost every dimension, that thesis starts to go out the window. And as Alan Blinder said, the probabilities that the Fed is higher for longer become a reality. And as rates are higher for longer, the price earnings ratios of stocks have to come under pressure. As these ideas about, you know, imminent rate cuts just get extinguished.
So to you, is this another bear market rally? And if so, then how far could we fall here?
Yeah, we're in the camp, as you know. We're very close colleagues with Mike Wilson at Morgan Stanley. And, you know, we have talked about the potential for kind of a boom bust scenario. And, you know, as folks recognize that, in fact, maybe the cost of capital is going to be much higher and the longer run pressure on corporate earnings is going to be much bigger, we would not be shocked to see, you know, a 15 to 20% pullback from current levels, which would take us below the prior cycle lows of roughly 3,600.
Which, of course, raises the question, what is an investor to do right now with their money, if that is what is ahead?
So, you know, we've talked about the fact with our clients that we anticipate that this is going to be a year where markets are extraordinarily range bound against a backdrop of very high volatility. That means, on the one hand, lock in some gains in the fixed income market, very short duration, you know, 4 to 4.5%. Returns from interest rates and potentially total returns as much as 10% in fixed income, you know, we think are something that should be in your portfolio. As far as equities go, we're pursuing very active stock picking, a very highly diversified portfolio with a focus on growth at a reasonable price and value. And we're finding that today across the board. So we're finding things to buy in biotech and semiconductors and software on the one hand, but on the other hand, in places like energy and industrials and financials and consumer services. So a very diversified portfolio. There are lots of things to buy. They're just away from this S&P 500 index, which continues, we believe, to just be overly concentrated in mega cap tech, expensive stocks that are going to have earnings headwinds.